Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers because I have a colleague, hopefully soon to be friend. I have Joe Brown with Heresy Financial with us. And to the viewers, I want you guys to know I've asked Joe specifically to come on my channel and speak about the bullish kind of aspect of the housing. I don't want you guys to think that we're stuck in some echo chamber. And I also want you guys to understand that we can still be friends. Hopefully, Joe, hopefully this will be my, and have a difference of an opinion. Now, I really, really respect Joe. We do differ on some things, especially with the housing market. As far as the economy, we actually share a lot of common agreements. But if you guys want more info on Joe, here's his channel right now. He also has a really big community. If you want to click here, I really do. I look up to your community, Joe. I see that you've put together a community where people are looking after each other. I really value it, and so I'm really looking forward to talking about what's going on in the housing market. Right now, as far as you see it. I had to turn off the fog machine back there. My God, I'm dying, man. I'm not sure what's in those chemicals, but it's something, and it's not good for me. But
Yeah.
How are you, Joe?
Good. Well, thank you for having me. And I'm excited to have a little bit of I don't know if this will be a debate, but I'm excited to have a little bit of, challenging to my thoughts on this, because I've been extremely consistent with what I've been saying about real estate since well before 2020. I started my channel in 2019, and my tune has kind of never changed. And I think the data still backs up my position. But I'm always happy to be wrong, to find out if I'm wrong, because there's no benefit in just, trying to maintain your position if it's not reality, because then you end up losing money. So I'd rather be profitable than right.
Well, I mean, yeah, man. I mean, iron sharpens iron, man. And I learned stuff. The reason I also reached out to you, other than Jack, is like the narrative that you were talking about, as far as a little bit more bullish on the housing market. It was practical. It wasn't just like some realtor, like, just buy, you guys, like at least you had a perspective, at least you had data, and I could comprehend what you were saying. I could see, that tunnel. And so I'm really happy, but I want to start by just giving you the microphone. And if you could tell the viewers, and I want you to talk as long as you need to, and then I'll ask you some questions, but could you tell the viewers how you see the housing market moving forward right now? What do you see happening in the housing market, Joe?
Man, lots of things. And so I'll start off with a couple anecdotes. So last year, I had 4 separate couples talk to me that don't know each other, are all over the United States. Same exact conversation from all 4 of them. Something to the effect of, number one, I had the money to buy a really nice house that I could have afforded a couple years ago. I thought the housing market was going to crash, so I waited on the sidelines, and now I might be able to afford a crappy house, and I'm wondering, if I don't get in on this, am I going to be stuck being a renter forever? Or, should I buy this and, risk that I'm buying at the top and there's going to be a crash? And my advice was the same to all 4 of them. And it was advice because they're close to me. So I could tell you, hey, if I was you, this is what I would do. It was the same thing. It was, yeah, you should buy. The risk to reward is not worth it for you to sit on the sideline and risk being stuck being a renter for the rest of your life, because the housing market might move away from you faster than you can save. And if it does, then you won't ever be able to get in. Versus if you do get in, even if prices come down, as long as you can maintain your payment, you just got to wait. Like there's the only risk of you losing if the housing market crashes is if you get forced out. And so the advice for them was like, hey, like, are you in a position where you think your job might be at risk? Like if, an economic catastrophe hits, like, how secure are you? What kind of savings do you have? Like, all that, take that into consideration. And still to this day, outside of a few local markets that are around the nation, that has been something that's turned out wildly in their favor. Now, I will say there's no such thing as the U.S. real estate market, right? This is something that my friend Jason Hartman always says. There are tons of different real estate markets. In every city, there's multiple real estate markets. And so we can look at the averages, and in places, I think like in Miami, they're seeing like a big correction in prices, which is like, obviously you're going to have that. The US average over the last 50 years has done extremely well. but you wouldn't have wanted to be an investor in Detroit over that same amount of time, right? And so there's differences in each local market. So you have to take that into account. And
Yes.
so some of the reasons why my position has been constant since 2019, when I started talking about this, until now, is you have to ask, compared to what? Like, yes, real estate prices are high. I'm sitting here and I've got this 1 ounce gold coin right here. Today, this is worth, I don't know what the price of gold is today, $2,500 or something like that. You can buy an average home today with the same number of coins, of gold coins, that you could have bought 10 years ago, 50 years ago.
That's crazy, Joe.
It is crazy. And there are periods of time where it's like home prices are more expensive in terms of gold. Right now, though, it's very, very average. There's no, if you're pricing things in gold, there is no price bubble going on in real estate. So then the question is, okay, well, real estate is expensive compared to what? It's expensive compared to dollars. Well, guess what? So is beef. So is orange juice. So is the stock market. Like, there are a lot of things that are expensive right now compared to the dollar. And we're not calling those bubbles. We're not saying that the price of cocoa beans is gonna crash. You ask the question, why is it so expensive? Well, maybe because there's something else going on when you see the price of oil or the price of something spike. And so when we're talking about real estate, what is actually going on? What are the fundamentals? What are the mechanics behind the scenes? And for the last, let's see, probably 13 years or so, there has been less development in terms of number of units being built, housing units, compared to the population growth. So that's just a fact. Even when you take into account the cities that have overdeveloped multifamily units, which that's actually happened in many big cities, even when you take that into account, there's more people that need a place to live than there are places to live. And that ratio has become more and more imbalanced since for about the last 13 years. What else is true? Over the last 50 years or so, the number of people who can live in a housing unit has gone down. So it used to be that on average, there'd be like 5 to 6 people per housing unit. When you think about, 40 years ago, 50 years ago, grandparents, it's like, yeah, we had a 2-bedroom house and there were 5 kids and we were all stuck in that 1 bedroom, right? Or maybe it was a 3-bedroom house and the one sister got 1 bedroom by herself and the 3 or 4 brothers were packed into 1 room, right? That's how my dad grew up. And so that's just the way people lived. Today, it's the opposite. You get a 1 or a 2-bedroom house, you've got 1 or maybe 2 people living in there and they're roommates. Not only that, but even when you look by square footage, it sometimes gives you a false idea, because a lot of the big multi-million-dollar luxury properties are still only 3 or 4 bedrooms. They're not 9 or 10 bedrooms like maybe the mansions used to be when they were built, 50 to 100 years ago, when there was multiple families living on the same compound. So we just have a different environment today where there are way more people that need a place to live, and the places that there are to live can accommodate fewer and fewer people. And even those places, there are fewer and fewer of them relative to the number of people that there are. Now, when you take a look at price, the reason why prices are high is largely due to the fact that we've had this big buildup of leverage in order to purchase that real estate over the past, 50 years or so. Mortgage rates since 1980 through 2020, just like all other interest rates and just like inflation, were moving down over that period of time. So that allowed prices to expand because the cost of the monthly payment to service that debt relative to income continued to go down and down. It was easier to buy a house in 2015 than it was to buy a house in 1985, just because of the way that leverage works. 30-year fixed rate mortgages made that a lot easier. Subsidies, things like that. These are all things that end up pushing the overall price higher. Now, a lot of people are predicting, especially like a lot of people who are like big social media influencers in real estate. They're saying when the Fed drops interest rates, real estate's going to explode. You know, that's not my position. I don't think the Fed's going to drop interest rates. I don't think we're going to get to a point where this year and next year, the Fed's just going to say, all right, interest rates down to 2.5%. We beat inflation. And
why would they stimulate, Joe? Like, people are missing that. Yeah,
yes.
right.
So that is not built into my bullish case on real estate. My opinion on interest rates is that inflation is going to be higher for longer because they're going to have to start monetizing the debt again. And that's going to make, the money supply increase. That's going to be what's going to push up prices, regardless of the fact that interest rates are going to stay high. We'll probably see new federal programs come out, like federally subsidized or backed 40-year mortgages instead of 30-year mortgages. We'll see, first-time home buyer programs where you get a lower interest rate up to a certain amount. So we'll see stuff like that come out to help the first-time home buyer, the little guy, get in. But all that is extra buying power that pushes prices higher. And I've been saying this since 2019. If you don't buy a house because you think everything's going to crash, you're going to be wrong. And eventually you're not going to be able to buy a house ever. And we're going to be separated. And the only people who are going to be in real estate are the people who got in prior to a specific date. And we're going to be separated into a nation of landlords and renters, or otherwise like we're on the road to serfdom, like F.A. Hayek's book.
Yeah, I mean, a lot of good points. And let me ask you, Joe. So first of all, I was still helping people buy real estate in 2019, 2020, 2021 because the rates were really low and the equity growth was still sustainable. So I really didn't start warning people until 2022. And right now our housing market, Joe, and I'm sure you would agree, is nothing like 2021 as far as like super low interest rates and skyrocketing, equity. So if we look at the housing market, maybe post quantitative tightening, right? So if we look at post quantitative tightening, and then if we analyze the run up from arguably about 2020 to maybe middle of 2022, the equity run up. Do you think it's any issue with the, because a lot of people, including myself, think that equity run up alone, just that alone, not talking about unemployment, but that alone broke the fundamentals of income growth for the nation. I mean, people, if we look at real median income, obviously adjusted for inflation, it's been going down since 2019. Lagging data, I don't even have 2023 yet. But do you think it's an issue? Do you think that the prices ran up way too quickly for income to be able to sustain those prices? Or do you think that's a non-issue because of maybe lack of inventory? Or do you think that there's any practical premise on sustainable fundamentals when it comes to home prices?
I mean, it's affecting the opposite side of the equation just as much, if not more. I mean, the reason why people aren't buying right now is because prices are very, very high. It's unaffordable for a lot of people, not everybody, but most. That's also the reason why nobody's selling right now, because if one person sells, number one, 98 times out of 100, that person has a very, very low interest rate. So their monthly payment right now is cheaper than if they go to rent. Like most people who own a home right now, the vast majority of people, if they sold and went to rent, they would double their monthly expense for housing. So those people cannot sell because anything they move into would cost them more and they can't afford it. So the very thing keeping people from buying is also keeping people from selling. And the fact that we have 50% of homes in the United States owned outright with no mortgage, and then of the mortgages, it's 90% have an interest rate lower than 5%. And about half of them, about 50%, have an interest rate under 4%. None of those people are letting go of their homes. They're dying in their homes until it gets to the point where they could buy something for cheaper. They are locked in for good, unless they get forced out, in which case a lot of other things would be wrong. And that we could get there, but I don't think policymakers will let the economy crash that hard that would force those people out of their homes.
I mean, I'm going to agree with exactly what you said because I own a house. It's kind of a forced landlord, if you will. My mortgage payment, Joe, on a 3,300 square foot, it's $2,000, bro.
Yeah.
And my rent in a smaller house right here, $2,400. Yeah. So you're right. And I get that. We look at, golden handcuff effect. So then I asked, what incentive is there to sell if someone has to sell, if they're going to be paying more in rent? Well, possibly they would be forced. We always have forced selling, maybe not enough forced selling, right? Maybe there's so much demand that's absorbing that. And that's what I have seen in most markets. But I appreciate that. So essentially, the income fundamentals, the sustainability really not an issue per se. But Joe, can you tell us what happened then and maybe I could compare it, completely different economy, completely different system, but let's talk about the GFC. Let's talk about what happened there. And outside of just subprime, now obviously subprime, so please talk about subprime, please talk about also speculation, because speculation was also a huge problem. Investors went to liquidate. And can you tell me what happened in the GFC that you don't believe is going to happen now?
Yeah, well, definitely. I mean, we don't even need to touch on subprime. Most people back then had adjustable rate mortgages, like your average middle to upper class. Everybody had multiple houses and everybody had adjustable rate mortgages. And so they looked at their situation. They said, I've got two houses. One of them never got a renter in it, or the renter just left. So this house is empty. So we had a massive supply demand imbalance the other way compared to where we have right now. So we had empty houses. They weren't cash flowing. And now the payments just increased. I can't afford the payments. Not only that, if I just walk away, I can get something for way cheaper than what I'm paying right now. So the incentive was flipped. I can stop paying. I can walk away. I can sell. I can foreclose. I can send the keys in, whatever. I can go to something. I can save a ton of money. We're also in a recession. Things are hard. Maybe I got laid off. Maybe I got a job that pays worse. Obviously, I'm going to allow myself to get forced out. Maybe they could have made it work if they want, but why would I continue to paying $2,000 to $3,000 a month for something when I can just walk away from it and go pay $1,100 to $1,500 a month for the same thing, or potentially even better? So there was a massive incentive on the other side. So we had way oversupply, adjustable rate mortgages, and a lot of people that were middle to upper class had multiple properties that this was happening to them on all of them. And so not only could most people not afford to keep them versus today where most people can't afford to sell them, but the incentive was opposite. If you left and went to do something else, it'd be cheaper versus now it'd be more expensive. And so it's just the fundamental reasons are completely the opposite today than they were back then. And again, I don't want to say that it can't get to that point, but the economy would have to get to a really, really, really bad, dark place where you have mass layoffs all across America for it to get to that point. And in all likelihood, policymakers will try and step in, print money, lower interest rates, do stuff if it does get to that point, which housing moves slow. So that would add fuel to that fire.
Yeah, I mean, and so essentially what you're saying is the incentive back then for the people to get rid of their house, it wasn't necessarily equity because people didn't have it. It was because renting was cheaper, basically. Is that right?
Yeah, definitely. People didn't have equity, which again, a lot of people today do have a ton of equity.
Right. But the thing that's interesting, Joe, is you're so right, man. I mean, the dynamics are so different, but it's still much cheaper to rent versus own for
only
like post QT. Right, post QT. And so like
that's a really important point though. Only for new buyers.
Yes,
because back then it was for everybody.
Everyone.
Anybody could walk away from their house and they would
they were cashing in on the equity like an ATM machine, and so they had no equity. Equity started going down. They're like, we give up. So it was different. But what I'm trying to figure out for myself, for my viewers as well, is like how big is that box of like post quantitative tightening? How big is that box of buyers that don't have that 2020, 2021 equity growth? They don't have those lower payments. So certainly we could agree that there is definitely more incentive for the post-quantitative tightening buyers to sell potentially if there's a hardship rather than the pre-quantitative tightening who are sitting on payments $1,000 less than rent, right?
Wait, you're talking about two separate people here. You've got one set of people who already owns a home. Should they sell, cash out on the equity, and go and rent, or you're talking about people who are currently renting, should they try and buy? Those are two very different people.
No. So what I'm talking about is homeowners. Let's just say homeowners that bought before 2022. Okay. And then homeowners that purchased a home after 2022. And I know it depends on the market, but when we look at the statistics, if you purchased in 2020, you got 30% in equity with a 3% rate.
Neither one of those people can sell. They can't afford something right now.
But my point is at least they have the equity like they didn't have in the GFC. But I'm trying to make the correlation, not all, but a lot of people that purchased after 2022, a lot of those people don't have equity.
They still can't afford to sell because if they sell right now, they're going to be paying more than what they're paying right now.
It depends when they bought, right? Because if we look at the stats, it's what, 50%, depend on the, I mean, it's like you said, it's so hard to talk about this because it's about subdivision. But I mean, if rent is cheaper than the new house that they bought is 50% cheaper, then certainly it would be it would be fair to compare the type of ownership. I mean, and another
well,
thing, Joe,
no,
real quick.
if renting is cheaper for that person, then all likelihood they've got negative equity, which means again they still can't sell. So the person that has equity, they probably bought before 2022, so they can't sell because they can't afford the new rent. The person that has negative equity can't sell. Well, I mean, yeah, but then you're going to be taking a massive hit. So either one of those scenarios, the home owners right now are in a position where if they try and sell and go rent, it's going to be a worse financial position for them. The only people that are waiting on the sidelines right now, those are the current renters, the non-homeowners.
So not talking about, so like what I'm trying to do is try to understand like where would we get inventory from, right? If there's going to be forced selling, like, so what I'm trying to figure out, all right, so where would there be forced selling? Like, how do we get enough inventory for it to make a difference in prices? And a lot of people, right. And a lot of people would say you got to have a certain element of forced selling in some capacity. And so when I look at like the data is so different, Joe. Like before middle of 2022, those again, a lot of those homeowners, they're in comparably great shape. But if I buy a house today, right, I don't have those benefits. I don't have the cushion. And I'm just trying to make that difference because, again, the GFC, everyone was like, didn't have equity. It had like an adjustable rate. But right now we don't. And so what I'm wondering is like, so that's a factor. That's why it's lasted as long as it is. We have these rate locked in golden handcuff homeowners with, they don't really have an incentive to sell unless they are forced. Okay. Right. Other than the normal death, divorce, that's every year. So
even that, it's going away. People are divorcing and they're staying in the same home.
I know. That's crazy, dude. But like, Joe, it's just like, I see what you're saying. And it's like, there is a different, but there are still some homeowners from that perspective of incentive. There are some homeowners that are similar to those GFC homeowners, but most of them are not.
Most of them are not. Because again, if you bought before 2022, you're going to be doubling your payment if you sell and go rent. If you sell and buy, it cancels out, right? The supply and demand, if you sell one thing and buy another, you're paying a lot more, but that cancels out. You're one supply, one demand, right? So we're not talking about that. We're talking about people who own and going to rent. That would push prices down. So the question is, okay, people who bought before 2022, they're going to be increasing their payment by a lot. And so they're not selling. The people who bought after 2022 are probably somewhat negative equity right now, maybe break even, which means after fees, they're going to be negative, which means they're not going to sell either unless they're forced out. That's the key difference. Rent is way more expensive relative to how it was during the GFC. During GFC, anybody could sell and go rent, and it would save them a ton of money. Now that's not the case.
And I agree with you. But what's interesting, what I'm trying to say is like, yes, that's for people. We're generalizing. We both know, and to the viewers, we're generalizing. We can look at specific markets we do, but like, again, if I'm a recent homeowner, if I purchased in the last year at a 7% interest rate towards the peak, I could still sell my house or get rid of it, maybe pay a fee to get out of it and still rent for 50% cheaper.
Right. And
you said there's not a lot. Now, if I look at the transactions, you're right. And I acknowledge it, like most of people, that purchased or not, but still there's got to be the transactions over the last 2.5 years of 10 million to 12 million people. And so what would happen, obviously this is impossible, that would all come to the market at the same time. But Joe, it's changing. Things are changing. And it's like, how long are we going to stay in this environment of quantitative tightening? And what's interesting, Joe, is like, and this is not sustained. So I want to acknowledge this. This is not a sustainment. But in 3 states, in Texas and Florida and in Arizona, for existing homes, we are now exceeding pre-pandemic. The question that I have, though, we need it sustained. If we get to pre-pandemic inventory and it goes straight down for any number of reasons, that may be an issue. But do you think, Joe, that we can get to, in the future, a scenario where prices do go down because we have enough inventory for that pressure to actually make a difference in the prices going down? Could you just break down your thoughts on inventory and how important that is?
I actually think it's not as important as most people think it is, because the only reason that inventory would go up is 2 reasons. Number one, interest rates drop, which means all of the millennials who don't own homes, who have been sitting waiting for a crash, they think now's my time. So inventory goes up if interest rates go down because everybody's finally able to sell so that they can buy something else that they want more. So that
Agreed.
inventory cancels itself out. So that inventory is not an issue that pushes prices down. Inventory will go up, but prices won't go down as a result of that. I don't think that's going to happen. Option number two, in which case prices would fall, would be the economy gets so bad that we have mass layoffs and people get forced out. And that can definitely happen. I don't think it will, but that could definitely happen. Outside of that scenario, we don't have something brewing that can push prices down because the fundamental imbalance is between supply and demand, which means even if everybody who has bought in the last 3 years decides I'm going to sell right now, even though I'm not forced out, regardless of the price, I'm going to be underwater. I'm going to sell it for less than I owe, and I'm going to walk away from this and go rent and pay more than I'm paying right now. Well, guess what? All those people still need a place to live. So what happens to all of the places that they're going to live? Rents go through the roof, and suddenly there's a massive opportunity for investors to snap up all those homes at the below market prices and rent them out for more. So we don't have a situation in which inventory alone can make a big difference on this because you still have the fundamental supply and demand imbalance between the people who need a place to live and the number of places that there are to live.
You know, and I agree with a lot of metro areas. It's just interesting to see that supply and demand balance kind of shift the other way in certain states like Texas. And I believe, honestly, Joe, I think a predominant reason, because I think about that, I'm like, okay, well, what the hell about Maryland, though? Maryland's got no inventory. Like, how's that going to go down in prices, right? I really think it's fueled by new home construction. But I wanted to go back to something that you said about, like, if you sell, you're going to buy. It's hard to get the data. I don't trust all the data, right, for obvious reasons. But the net is supposed to be 30%. It's supposed to be a 30% net. If like we got 100 people that sell, 70 are going to buy. 30% are going to, maybe it's a second home, maybe whatever. So there is a 30% net, but your point is understood. And, so how would you explain new home construction? So new home construction, and I've looked at the size, and there's an adverse correlation because of sentiment, in my opinion, okay? So how would you explain, and they have recently gone up, the last data actually, it went up from month to month, Joe, $30,000. So it's like, oh my God. But before that, dude, it was down from peak of October of 2023. It was down 19.2%. Inventory has also been over 6 months for over 2 years. How would you explain that price decline based on that inventory and the lack of demand absorption? Or how would you classify and it's median? It's not a true definition of value. I understand that, but how would you explain new home construction?
One of the big issues there was a lot of the developers wouldn't pre-sell those homes because they saw everything skyrocketing during 2021, especially, and 2022 a little bit, but mostly before that. And so because everything was skyrocketing, they're like, all right, this is going to take, a year, 2 years, whatever. We're not going to let anybody lock this in and buy this ahead of time. We're not going to lock the price because the longer we can force this to get delayed, the more money we can make when it finally is finished. Well, it just happened that was a boom, and it was a false boom. And so when interest rates started going up because because of inflation, the Fed started raising interest rates. Suddenly, nobody could afford those houses that they had signed up for. Now you've got a bunch of empty lots where they didn't lock in those buyers ahead of time, and now they're sitting there with all of these empty homes, saying who is going to be able to afford these homes at these interest rates. Now it's not like like you talked about, there's individual markets. So a lot of this is very, very concentrated in specific areas. When you look at the average in terms of like the bulk of the numbers of these new developments, what has actually happened in many areas is that this is actually the only supply that is coming on the market because everybody's locked into their low interest rate houses, so they're not selling. So if you do have somebody moving into the city or changing from being a renter into an owner, the only available homes on sale are these new builds. And so in many cases, this ends up being the only supply that there is. But it definitely depends on the city, on the market that you're looking in. Some of these are wildly different.
I'm in the number one market for new construction.
Yeah.
So I got a lot of ammo. I'm just like, no,
Yeah.
because we're talking about the nation. If I only want to talk about Houston, I'm not going to waste your time on that. You know,
Yeah.
but what's crazy about Texas, specifically Houston, is Lennar's been offering a 4.25% for 2 years, fixed rate for 2 years, and they still have hyper supply. So even with that lower rate, Joe, those prices are still high. And then we got property taxes. Let's not forget. So we got, even though that rate is low, making their payment, I would maybe artificially low compared to the market, they still brimming with inventory. Now, I'm not going to, I will also acknowledge the migration absorbs a lot of it. So there's still enough migration, even though it's number one, and I'm seeing and I see price decline in Houston. In Houston, on a subdivision level, I go subdivision, and in Houston, a lot of Houston, not every subdivision, some subdivisions, they're still going up. And if like that's your goal, it's a different method to buy. But a lot of subdivisions in Houston area peaked in 2022. And so I'm able to find like better deals than 2022. I mean, how could you not? They had bidding wars, you know, and appraisal gaps and things like that.
Yeah.
But it's very, very interesting, Joe, because the markets are just like, my God. And I want to get to the economy. I know we have a little bit of time, but I wanted to ask you this real quick because I really value your perspective, especially on economy. Going back to the GFC, speculation, okay? We can both acknowledge that there was an issue with speculation. The adjustable rate mortgages, I hear you on that. A lot of people had adjustable rates, but also they cut rates during that time. So some of those people actually, their rates went down depending on the arm. Because some arms, it's just going to go up no matter what when it matures. So it depends, right? You had the 12 mat, the payment, you had all this stuff. But let's talk about speculation. Arguably, depending on the data, depending on the metro area, depending on the subdivision, do you guys get it yet? Right? You guys get it? You got to understand what's going on in your market. Everything we're talking about, Joe and I, is all macro. The only way to get micro usually is subdivision. So anyways, the speculation is arguably double right now than it was from the GFC. Can you see that level of speculation in this market having a negative impact on the prices, especially when we take into consideration the STR bands, the short-term rental bands like Airbnb, VRBO, specifically in places like Dallas? I've looked at the inventory. The inventory of short-term rentals matches doubles in some situations. In some metros, the active listing counts for both rentals and homes. I'm only saying that there's just a lot. And it is concentrated in metros. Do you think the speculation makes it a little bit more dangerous, Joe?
Well, let me clarify something. You said the speculation right now is arguably double what it was in the GFC. Can you make that argument? What are you calling speculation, and why do you define it as speculation?
Yeah, let me pull. Actually, I had the data chart, but I had to restart my computer because I was hoping you would ask that. But yeah, so I have that, and actually, I'm going for actual units. So the unit amount. I may have this screenshot. I got it from Twitter right before I went on here. I'm like, oh, Joe's going to like this. So you could basically see. I have to get it, Joe, but it's on Twitter. It's on X. And it's a graph that they show, and basically they show the graph, you know, kind of just going up a little bit, and then when we hit GFC, it goes up, does the peak, and it kind of comes down. And when we compare, the same thing happened in around 2021-ish. We had this massive peak, and then going down as well. But the size of the peak is double the size from a unit standpoint. And I'm only talking
how is speculation being defined?
Let's just say how about second homes, non-owner occupied. Let's just say non-owner occupied rental. It could be a rental property, could be a speculation property.
Wait, why is that speculation though?
Let's say a second home, any property that you don't own. Let's just say.
I'm sorry,
any property that you don't live in.
But why is that speculation? Like if I have a portfolio of B class single family homes that are being rented out, what classifies that as speculation? I was
just going to go, but we don't have to call it speculation. So just say,
well, that was your question though. So I'm trying to figure out, like, because you mentioned short-term rentals, but then you also mentioned long-term rentals, but you also mentioned my second home that's a vacation home. So what is, and because you're saying that speculation is higher now than it used to be. So
I'm just going to say non-owner occupied. Non-owner occupied. Let's just say non-owner occupied. All right. That way we can cover broad. right? Second homes is non-owner investment, Airbnb, long-term. It's a lot of non-owner occupied. And really what I'm emphasizing, Joe, is like those non-owner occupied, we don't have the same type of tax protections. We don't have homesteads, property taxes going up, homeowners insurance is higher. We got hurricanes now in Florida where there's a lot of investor-owned properties. And what I'm saying is do you think that there's enough of that type of non-owner occupied investment purchasing, enough of that naive, I'm just going to YOLO perhaps buy an Airbnb, that it would cause an issue? And I say that, I want to give you just this last thing. I'm so sorry, bro. I've noticed a trend in my market. Again, it's just my market, Joe. And I'm glad to. I have realtors come up to me and say, Travis, I just bought another house. I'm turning it into an Airbnb. My first question, Joe, because they're shutting it down in Dallas, can it cash flow long-term?
Yeah.
And you know what? They almost always say no. So I don't know what percentage that is of uneducated investors, but there is a certain amount of those people, those non-owner occupied people that are just purchasing real estate without understanding what they're doing.
Yeah.
That they're in danger. And that could be a second home. That could be a long-term, short-term. But I'm saying, Joe, like there's not a lot of people that are smart like you. And I'm not knocking on the viewers. It's just most people don't care. They just want a roof over their head. They want their family to be okay, and they want to make sure they can get through any turbulence. So do you think that, what an impact do you think that the sheer amount of increased investing is in the house market? Do you think it's going to make it stronger through a harder time? I mean, or do you think it would potentially make it weaker? Do you know what I mean?
Yeah. At the end of the day, it's all just buyers. And the only reason that buyer exists is because there is a profit opportunity. So I look at, when you look at the millions of homes that institutions and hedge funds purchased over the last 5 years, this is something brand new. These are not companies that are uneducated buyers speculating on a whim, hoping the price goes up. These are homes that are literally off the market forever. They will never be sold to an individual again. These companies will own these homes forever as rentals, and that's not going to change. They are gone off the market. So that's number one, that most of what is being classified as speculation in this doubling since the great financial crisis is not speculation. It is very well-informed investing. So that's number one. Number two, the only reason these opportunities are profitable is because, again, the supply and demand imbalance of people who need a place to live versus places that there are to live, they're being rented out. None of them are vacant. They're cash flowing. And that's the long-term rentals. So now I want to pull back the curtain a little bit behind the scenes of the short-term rental market, because for a while I was looking at this and thinking, this is absurd. There are a lot of short-term rentals, and there are definitely cities that are shutting this down, and there's risk of massive losses in these areas. But I'm going to go out on a limb and say that a lot of these places that are looking to shut short-term rentals down outside of markets like Las Vegas or Hawaii, a lot of these regular city markets that are looking to shut down short-term rentals will actually not succeed. And here's why. Who is buying short-term rentals? Most of the time, it is actually not the uneducated person with a little bit extra cash flow that wants to start a side hustle. Most of the time, the people buying short-term rentals are extremely high income earners trying to offset their taxes. There's a little part in the IRS tax code that says if you have paper losses on your rental property, those losses can only offset passive gains. So if I have depreciation on my long-term rental, that can only offset my rental income. But if I'm a doctor or a lawyer or, another high income earner, software developer, whatever, I'm not going to go buy a long-term rental because I can't use those losses to help me pay less taxes on my earned income. But there's literally in the Internal Revenue Code section 469, it says, if the average stay on the property is 7 days or less, it is not a passive activity by default. It is non-passive, which means you can buy a short-term rental like me, high
Yeah.
income. I have to buy short-term rentals because it's the only way that I can offset my taxes. Buy a short-term rental, do a cost segregation study on the property, take this year's bonus depreciation of 60% of that accelerated depreciation, use that to offset my income. And as long as I buy the property with leverage, that means I'm getting more than a 1-for-1 dollar offset on my tax savings. So if I spend $1 to buy a property, I'm saving $1.20 to $1.50, sometimes $2 on my taxes, which means that only high income earners are buying these properties only to save on taxes, which means even if I don't cash flow, I'm still making money because I don't have to pay Uncle Sam. And so the very fact of the matter is all of these people have high incomes. They're not going to just sit idly by. They're going to be in there lobbying and petitioning to make sure that these laws don't get passed.
For sure.
So that's my take on it.
And you must love your Schedule E, don't you?
Yes, and that's another thing for anybody who's listening to this. You go to your CPA and they say no. If it's a short-term rental, then it's non-passive, which means it classifies as Schedule C. Do not listen to them. Don't walk, run. Short-term rentals are not Schedule C unless you're performing substantial services like an actual breakfast or something like that. It's Schedule E.
I understand. So, and you went out on a limb, and I'm going to hold you to that limb. You said the Airbnb investors are smart, man. All right, Joe. All right. But I want to tell you something, man. And again, this is my market. I know my market's way different than Maryland, but I just did a video. I covered San Antonio, and I made a special trip to a listing that it was a home for sale, just had a price cut in a subdivision full of additional existing homes for sale. And the seller was actually American Homes for Rent. Mm-hmm. And I went back in the archives to see how long that property was listed for rent. I think it was listed for like 8 months for rent. Then they converted it to sell because they wanted to get rid of the property. And then they couldn't sell it. So now they're price cutting. And so, Joe, that is happening.
Yeah.
But you don't think it will happen on a nationwide level? Like it's a pocket.
Substantial. Yeah.
And do you think that's because the institutional investors only own in certain parts, or you just you just think a house is a explain to the viewers this, okay? Because I want to get into the economy. I'm just really enjoying this conversation, brother.
Yeah.
One of the things that I definitely, and you mentioned this a little earlier, and I agree with you here, okay? And which is the 10 years, right? Like that 10-year cycle. If I would have bought in 2008, as long as I could have made it, say, 6 years, I would be having way more equity right now. And so I would agree, if you can hold for 10, you buy right now based on emotion. Okay, this hypothetical, you buy right now based on emotion, you buy an overpriced price, you don't care. You wait 10 years, odds are that house is going to be worth more. So I want to acknowledge that. But for me, I couldn't last that 10 years. And that was my own personal mistake. And I was this young prodigy, Joe. I'm not young anymore. Dude, you would have beat me up if you'd have seen me back in the day. I was so cocky, dude, because I was making too much money, bro. I wasn't listening to anyone. And I lost my job, and I was living paycheck to paycheck. And, I had a whole bunch of debt. And, I lost everything. And, I guess what I'm trying to say is right now I believe in a ton of caution because I like how you gave credit to the Airbnb investors, but I definitely think that consumers, and I'm not knocking them, Joe, most consumers had a lot of work to do that they're not doing. And honestly, it would be harder for us to make money and to become successful in real estate if most people were purchasing wisely. I would argue that one of the reasons why real estate can be so beneficial to people is because there's so many people that don't give a crap and that are just buying. And some of those people get into trouble and they need to sell quickly and they offload it under market value, do a short sale, whatever. And I think that really, Joe, I think that's the difference in you and I, because I would agree with a lot of what you're saying from an investment standpoint. Like if I have my PE ratio is maybe 2, right? Like I make enough money. If anything happens, I have my safety net. I have 100,000 or whatever. I'm a successful investor, right? I'm going to hold for 10 years. I'm cool, right? I know my property taxes are going to go up. I know there's Airbnb laws. Like I get it. If you're smart and you can maneuver and you have money, I get it. 10 years, it should be worth money. And I would agree with you. I would. But Joe, I don't think most people are like that, brother. And I don't want to judge people, but I do believe, part of that price run up, other than the lack of sustainable fundamental, like the lack of income growth, it was driven by fear of missing out. a lot of it was driven by emotion. And I'm sure, Joe, most cases, you would not advise someone purchase a home online or purchase a home with an appraisal gap. In most situations, obviously there's unique situations, but don't you agree that most home buyers are not purchasing real estate like you would recommend your community do? Caution.
Sure. Yeah. I mean, I never talk to most people. I'm not sitting here saying, "Hey, here's a theory on how everybody can get rich." You can't control everybody, but you can say, "Here's a system that anybody can use to get rich." Most people aren't going to do that. Who cares? I'm not talking to most people. I'm talking to the people who are going to do it right, who are going to do their due diligence, who are going to make sure that, hey, you know what? I actually can't afford a $4,500 payment. I can only afford a $3,500 payment. So either I have to keep on renting until I increase my income, or I have to move to a new city. Like, I'm not going to sign up for something if I know, like, who's going to go and build a building and not see what the total cost is going to be before they build the building. If they're like, oh yeah, I'm going to go break ground and start building this building, and because I've got $500,000 in the bank, and it's like, oh no, it's going to be 5 million. Nobody's going to do that. Like, you have to figure out what the cost is going to be and make an educated decision. So I'm not talking about what the people are going to do who are just making foolish decisions out there. If you're talking about on average, has the big run up in prices been as a result of that? Absolutely not. FOMO and euphoria are the same thing, and we have not had that in the real estate market since before the GFC. If you look at the last 5 years of sentiment on home buying, it has been in the absolute bottom. 0 people in the world think that it's a good idea to buy, unless you're a real estate agent. 0 people think it's a good idea to buy right now. Crashes don't happen when sentiment is in the toilet. Crashes happen when there's euphoria. So no, I do not think it was driven out of euphoria, driven out of FOMO. It was driven out of, there is no other option, because we all need a place to live. And that dynamic is going to continue.
Isn't there a certain fear though in that dynamic? Like, I got to live somewhere. I have to hurry. Isn't there an element of fear in that?
Fear of missing it. Like, if I don't buy now, then I'll never be able to buy.
Yeah. Because Joe, I mean, you know realtors, man. I mean, they know how to play emotions, Joe. I mean, they're playing these people's emotions. I guess I just, I only have a little bit of time. I'm past 4:08, so please don't kick me out. But I got to move on to this next thing for my viewers and for myself, because I have you here. Can you talk about briefly, please, the labor market? All right. I just want to say that you said it yourself. Yeah. Okay. If there's skyrocketing unemployment, yeah, it's going to collapse. Can you tell the viewers what's going on with the labor market briefly, Joe? And then under what circumstances you can see that skyrocketing unemployment? I'm sorry for rambling, brother. I know I'm late. If you have to go, just let me know.
It's all good. Yeah, no, the labor market is definitely not as strong as it seems. So when you take a look at the last year and a half, a couple things are apparent. Number one, people are losing full-time jobs and they're replacing them with multiple part-time jobs. So that is apparent. One of the things that is resulting in is an increase in wages, because if you get 2 or 3 part-time jobs, many times that's enough to overcompensate for the one full-time job that you lost. But expenses also go up as a result. You have more travel expenses. You don't have the benefits that you had before with the full-time job. So healthcare costs can go up. So there are all sorts of problems with this. Not to mention the fact that people are working more just to make enough, just to be able to afford the same things, because yes, they have wage increases, but inflation is also still rising. And so people have to pay more for their stuff. It's also causing an increase in money velocity, which is, money velocity can be enough to keep inflation going. What else? We are seeing, we're seeing jobs adjusted. So when we look at the reports, every single one of them, a couple months later, they go back and they adjust the numbers down. Guess which numbers are the only ones that are being adjusted up?
Hold on. Unemployment?
No, government jobs.
Yeah.
So not only is are government jobs the only ones that are growing in terms of that's where all the hiring is, yes, but it's disproportionate, way more than private sector. And every government job is a net drain on wealth for the economy because it is only funded through inflation or borrowing or taxes, which is funded by the private economy. And that job only exists because the private sector was not already doing it,
Yes.
because it is not profitable to do that. Therefore, the government forcing that to take place is a net drain on wealth in the system. And so all of this growth of government jobs that we have is actually becoming a bigger and bigger financial burden on the economy. It is not good growth, even though it shows up in the numbers that way. And so we have a terrible labor situation in the United States right now. And absolutely, it could tip over and we could see massive layoffs and we could see a bunch of stuff happen where people start losing their jobs and get forced out of their homes. My opinion is if it starts to tip over like that, what you're going to see, number one, is you're going to see government action. You're going to see a lot of borrowing. You're going to see a lot of spending. You're going to see a lot of financing of that borrowing through the Fed, which is printing money. And that is ultimately going to push up on prices. So you get stagflation, basically. And that is not something that is bearish for assets. A lot of that new money goes funneling into assets. And that's why when you see places like Venezuela, the quality of life crashes, hyperinflation goes up, stock market skyrockets, melt up. And that's what you see during big inflationary times where the quality of life declines.
And talking about the government jobs, and again, you're further along in this than me, Joe. I will acknowledge it. I've read a lot of stuff that basically says that's another thing that is a warning of a recession. It's an indication of an unhealthy economy is those government jobs. We need the private jobs. And so, Joe, under what circumstances, because we kind of would both agree that, unemployment is kind of something, especially in tight markets like Maryland, especially in markets like that, you need a softening labor market, to even lower demand even more so we can sustain the inventory. But what do you think would have to happen for that spiraling domino effect of unemployment, understanding that they have already been doing I almost said quantitative easing like they're buying. Understand that they're already kicking money in to stimulate the labor market, like government jobs. I mean, what do you think that piece of the puzzle will be? Do you think it's just time, Joe?
No, there's always a catalyst, and those catalysts are usually explained in hindsight, and people say, "Oh, yeah, this was clear to see. Like anybody could have predicted that this was going to happen." But the reason why there are catalysts that causes things to crack is because nobody anticipated it. So that's the definition of a black swan: is that nobody was anticipating it ahead of time. And so the catalyst could be anything, and we don't know it could be war. It could be an oil price shock. It could be, who knows what the catalyst could be. So it could be anything. I will say, though, that I think that what is happening is there's a difference between this should happen versus what is happening or what will happen. So if I was to say, okay, what should happen? Well, we should completely deregulate housing. We should get rid of all subsidized mortgages, all federally backed programs. We should stop funneling money in because that pushes prices up. And there should be bans on even things like zoning laws because that's what prevents affordable housing from being made. Housing is technically a depreciating asset. It's something you buy that becomes worth less over time. It requires maintenance. We shouldn't see real estate go up and up and up. What we should see is what happens a lot in red states. There's a lot less restriction on building. So the building just keeps on happening. That's why a lot of states, why if you want to be a good real estate investor, a lot of times you have to buy in other markets, not the ones you want to live in, but other markets in other states and have property managers, because those are the only ones that are affordable to get into because you can buy a house for $90,000. You can buy a house for $150,000 and it still rents out. Still the cheap markets because there is still a lot of building going on. And so if you want to solve the supply problem, you just have to build. The issue is everybody who already is inside and already owns a house doesn't want the building to happen because it will negatively impact their own. So it's a selfish thing, but it would be way better for society if we had way more houses, way more small single family homes, if there was no restriction, and then they would be profitable. Builders could build those small homes profitably and sell them at a profit because they wouldn't have to deal with all the BS and the red tape.
Joe, it has been an absolute pleasure speaking with you. Now, obviously we don't agree with everything, and I understand I'm a little biased. I mean, I live in Houston, Texas. You can't blame me, and I've lost everything already, so I'm cautious by nature because I've lost everything. But I will say that I feel stronger by talking to you. I feel like you helped put some of the pieces together of the puzzle. You helped, me understand a little bit more of why people are saying what they're saying. And it does make sense, some of it. And I hope you understand also, Joe, where I'm coming from. I'm not just some crash bro. I mean, I legit lost everything. I have my foreclosure bankruptcy repo. And I've also taken a step back from sales. I'm a realtor, a loan officer, and CA instructor. And I've taken a hit in my income. And it's because I'm afraid. I'm afraid, and I'm going to be honest, I am afraid. I'm afraid to say, go buy a house right now. And I'm scared, Joe, and I'll be honest with you, man. Again, you help shine some light on that. But dude, like, I see the consumers, I see the consumers, the pain. I see the excess savings is gone from COVID. The delinquency rate on credit cards, the trajectory is insane right now. Used car, but we don't have the credit tightening. And we still have all this money. Right. I mean, there's money they're fighting inflation. How? The deficits. I mean, and so it's very confusing. And I think, Joe, even though we may not agree on everything, man, I hope I gave you a little bit of what you gave me and my viewers today, brother. And I appreciate you being here today. And would you give last words to the viewers? Can we end? I usually like to try to end on something positive, right? Some type of good news. What's the solution? And understand, my viewers, it's not necessarily as many as the ones that you have, where maybe they're a little bit stronger investors. Like a lot of my viewers, Joe, I mean, they're hurting, bro. I mean, they're scared, they're frustrated, they're upset. Any talk of investing, they will be upset at you. They will argue with you and say, I want a house. Why do you have 100? So I want you to talk to them, Joe. Can you end us out here, brother?
Yeah, absolutely. There is no benefit to shaking your fist at the world and wishing it were a different way than it is. And I spent far too long thinking about focusing on making content about talking about things the way that the world should be versus how do we benefit the way that it currently is. And if you want to make the world a better place, in reality, you have to be in a position to be able to do that. Many times that means accepting the way things are, taking advantage of it, and then building yourself to be at a stronger point where you can actually make a change. So if you want there to be affordable housing, maybe you need to get into a position where you can build affordable housing and change the local world around you. And the better you are at doing that, the more you'll grow, the bigger you can get. And so I would say instead of shaking your fist at the world, how about let's buckle down and we can say, okay, this is the way the world is. And I'm just going to learn the rules of the game so I can start playing the game to win. And that's not going to look like you wind up with 100 properties tomorrow and become, an evil, greedy landlord. Maybe that looks like, all right, here's my financial situation. I'm going to be diligent. I'm going to count the cost. What am I able to do to get ahead? Maybe if I want to start off with one property, I can't do that yet. Maybe I need to save up some money in something that replicates the gains that real estate would have. Like maybe I save up some money investing in a REIT for a while. And if real estate keeps on going up, then I'm able to use that to use for a down payment. And then I use that down payment, get into a house that is, a live-in fix and flip, fix it up, have equity, pull that out, and I can start to snowball that. Maybe that's not even real estate. Maybe that's saying I don't want to do that work. I'm going to live in a house that I rent because I like that house and it's cheaper. And I'm going to build my wealth another way. I'm going to start a business, whatever. Obviously, you can do whatever you want. You don't have to be shoestrung into, like, if you never invest in real estate, doesn't mean you failed as being an investor. Maybe you prefer small business. Maybe you prefer paper equities, paper assets like stocks. And so there's no right or wrong answer, but I would say the step one to moving out of the situation that you find yourself in is being honest with yourself about where you are, what your shortcomings are, and little by little, slowly but surely working on those one at a time and fixing yourself so you can get into the position to make the world a better place and help those around you.
I love it. Joe, love you, man. Thank you. Hopefully we could do this again. You guys, don't forget to go to his channel, show him some love. He's so, this guy's popular. I don't know if you're a millionaire or whatever, but he took his time to come here to talk to someone that he is a stranger to him. He didn't know what to expect. And I hope a little bit of a friendship, Joe. I want you back on here. I think you're a great colleague. I really respect and actually enjoy communicating with someone that has a difference in opinion if it's respectful. We don't have to yell and scream, although sometimes the viewers want us to, but I don't want that, man. I want to learn, I want to why are you saying this? Am I crazy? It's all helpful. And thank you for helping us today. And other than that, guys, go show Joe some love. And if you're out there investing in real estate, we wish you luck and we hope you win.